All right, guys, if you are a retail investor, every now and then Wall Street presents an opportunity. And in this video, the opportunity that we're going to talk about is SaaS stocks. So to start the year here in 2026, SaaS stocks have been getting brutally sold off by Wall Street. Wall Street does not want these names anymore because they are worried about AI disrupting some of their or parts of their business, right? And also, Wall Street is concerned about the multiples, right? So there was a time when these SaaS stocks traded at very, very high multiples. But now, of course, with the wild card of AI, Wall Street no longer has the certainty to allow these names to be trading at these multiples. So they are selling them off aggressively. Now, of course, anytime in the stock market where there is a sell-off of a sector at the rate of 10, 20, 30, 40, 50%, that creates an opportunity. And a lot of these names, a lot of these SaaS names, even the high quality ones like Salesforce, ServiceNow, Adobe, Intuit, and of course recent IPO Figma, these are getting destroyed, and some of them are down 50% from their all-time highs. And this creates an opportunity. So if you are a retail investor and you are interested in the sector in some of these names, now is the time to be paying attention. So let's take a look at some of these names here and how badly they've been selling off. So what we're looking at here right now is ServiceNow. ServiceNow, one of the bigger SaaS names out there, and you can see that the stock is just nosediving right now. And from its all-time highs, we are down about 47%. So that is a very big pullback, and it's also a very sharp pullback. You can just see here that it's not even finding a floor here. It's blowing through this support here. So who knows where this bottoms? And I don't think now is the time to buy any of these. You got to see how it kind of plays out. But that's why in this video, I'm really just talking about how this is a sector to watch and analyze and figure out where the value lies. So with ServiceNow, again, at its current level, we're trading at the same prices that we were trading at way back in 2021. So almost 5 years now of zero returns. But you can see here that if you go to the weekly chart, you can see here that this was a stock that could do no wrong for a very, very long time. All the way from like 2012 to 2022, you had 10 years of pretty much up only with very little volatility. Then of course you had this period right here where the Fed started hiking rates, and that caused a multiple compression, which brought the stock down. But of course, inflation started coming down, rates started coming down, so now the stock just shot back up. But now it is getting hit once again. So this is one of the most aggressive sell-offs that the stock has ever seen. Just look at the weekly chart here. You can see it's just red, 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 red. So really to start this year, or kind of started towards the end of last year, but now it's accelerating, but it's just been just down only here on the weekly chart. So if we go over to Intuit, another big name, this is another high flyer, high multiple stock that Wall Street has historically loved very much because of their wide moat. You have QuickBooks, you have TurboTax, tax preparation products like those, accounting products. You can see that this is just getting crushed as well on this weekly. Look at this weekly candle; it's just getting destroyed, and we're even dropping below the 200-day moving average here. And when was the last time Intuit dropped below the 200-day moving average? You can look here and this area, you kind of tagged it a few times, but you didn't really decisively break below. Same here. You look at the COVID sell-off; it just wicked. It just touched the 200-day moving average, but now we're actually decisively moving below the 200. So there's a lot of weakness here in these names. Same thing with Intuit. It's now been trading sideways for 5 years based on its current price here. But yeah, this is another stock that really could do no wrong. It was just up only all throughout here. And now it's just really struggling here. So we go down to the next one, Constellation Software. This is another one that's getting hit aggressively right now. So we're breaking way below the 200 here, like a very decisive move below the 200. And when you see this kind of move, it's very interesting because where is the bottom, right? And right now it's just it's a falling knife. It is down only. Where could it find a bottom? Who knows? You really don't know, but there's some logical levels that you could play throughout here. But once you lose a 200, I mean, these it's probably not going to just bounce right back up a month from now. I think that there is a psychological shift, a shift in the overall positioning of the market. So some of these names might be out of favor here for quite some time, So I'm not saying you got to go and rush in and buy any of these names, but this is a sector where you might be able to find a lot of value because these are asset-light business models. They're subscription models. They do have the ability to generate strong free cash flow per share over the long term. So this is really the time where you just have to build up a watch list of some of these names and research them and follow them and identify where the value is. Because look, if eventually the sector will recover and there's going to be a few winners that really emerge. And if you can buy them when they're down 50%, you could really outperform the market. So going on to the next one here, we have Salesforce. So Salesforce is another one that's just been struggling. It's not getting sold off quite as aggressively as the names we just looked at, but you can see here that it's just kind of hit a chop. It's just been chopping the last, again, about 5 years. It's just been doing nothing. Really has no direction. Kind of have a run here, pull back, but this one's kind of starting to break down a little bit as well. Of course, Adobe, we've talked about it on this channel before. This is another name that was a high flyer that just has had no direction the last few years and has sold off quite aggressively the last year and a half here. But Adobe's a name that the market loved for the longest time. You can look way back here during this run that kind of started in 2011. You can see that it was just up only. It was just up only. Just the stock appreciated from 2012 here to the top of about 2,000%. You got a 20x here. And of course, in that process, the multiple expanded rapidly. It was a high flyer. Very rich valuation, and now the market is normalizing. This is the normalization of the valuation, and of course the market's worried about AI. It's worried about all these things. But of this list, I guess another one here is Toast. This one's doing a little better, but it's also experiencing a bit of a pullback here. The Trade Desk. This is one that's been decimated by Wall Street. Just a very aggressive sell-off here. This one is breaking down as well. So who really knows where this one finds a bottom? Again, it's been trading sideways now for 6 years. This has just been chopping for 6 years here. Figma, that's another one, recent IPO. I guess it IPO'd back in July of last year. And you can see that, Figma is just, it's been struggling. It's been pretty much down only. So you see a lot of these software names, these SaaS names, have just been getting decimated by the market. And if you pay attention here, if you add some of these names to your watch list and do your research and follow the story, listen to the earnings calls, analyze the fundamentals, analyze the markets in which they serve, there is value here. I can assure you that there is value in some of these names. And if you're able to get them when they're down 50+%, and they eventually go on to triumph, you're going to outperform the market and you're going to do very well and you will be very happy. All right, so we just touched on the TA a little bit. So what are we looking at when it comes to the actual fundamentals? Well, here's Salesforce, so ticker CRM. You can see here that they have grown at a pretty healthy clip throughout the last decade or so. You can see 24, 26, 28, 24, 24, 18%. 11%, 8%, right? So you can see that they were growing in the high teens and even 20s for a while. Of course, growth has slowed down a little bit here, which is normal, that happens. But, they're still hanging on to around 10% growth. But, that is a decline in growth, and that's partially responsible for this compression in the multiple that we are seeing. But you can see that going forward for 26 here, analysts are expecting 9.5%, 27, they're expecting 11%, 28, they're expecting 9.4%. So they're still holding on to a very, respectable growth rate. But when it comes to why the stock is struggling, you really have to go over here and look at the forward multiple. And you can see here for Salesforce, if we go way back, let's see here. Let's just go back to 2016. So anyways, so this is back in this area. This is when the stock was very expensive, right? You can see that Salesforce was trading at a forward price to earnings ratio of 81 here at its peak. So in 2020, right, that was the year when the money was going everywhere, just Fed printing like crazy. They were trading at a forward multiple of 84.4, which is a crazy high multiple, right? That implies an annual return, like a business return of a little over 1%. It's a very small return. But you can see now that the multiple has just collapsed here. It really started collapsing around 2022, right? It went from 74.8 times earnings all the way down to now 18. But the interesting thing about this chart is that this is pretty much the cheapest it's ever traded on from a forward price to earnings standpoint. We were at 18, and we're about to, the lowest it ever traded at from a forward PE standpoint was 18. We're at 18.08 right now, so pretty much the lowest. And this continues to kind of drop off here. And so if we look back here in 2020, when it hit its peak valuation of 81, what was the company growing at? So we can go back over here, and we can see that the revenue growth at that time was right around, let's see here, right around about 26% roughly during its peak valuation. So you had 24% growth for an 81.9 PE ratio. Okay, so you had a PE ratio that was over 3 times the growth rate, which is very high. So a lot of this decline isn't necessarily because the business is doing poorly. A lot of this decline is just because these SaaS stocks became so euphorically overvalued kind of during that COVID money printing era. And now essentially the chickens are coming home to roost, and these stocks are taking a beating because Wall Street no longer wants to pay these high multiples. And also Wall Street really wants to see profitability, right? They want to see stronger profitability coming from these companies. So we can look at the operating margin, and you can see that throughout their expansion phase, they had a very, very low operating margin, 2.6%, 1.7%, and you can see here that that is beginning to change. They have been kind of starting to get it together here. It's just they went from 2024, 14 to 19 to 20 the last 12 months. Okay, so they are really beginning to optimize the business now, which is partially the reason why the valuation is dropping. But, for Wall Street, this just hasn't been enough yet. It just has not been enough. And I think the market wants to see, a stronger focus by management when it comes to free cash flow per share, operating margins, net margins, stock-based compensation, all of these things, right? You can still see that stock-based compensation is very high for CRM. It's $3.2 billion and growing. So stock-based compensation is actually increasing as opposed to decreasing for Salesforce. And Wall Street doesn't want to see that. You don't want to see all the stock-based comp, right? You want to see stock-based comp declining, not accelerating. So there's multiple reasons here for the sell-off. How about let's go to the next one. Let's look at ServiceNow, and I think we're going to see a similar story here. So ServiceNow, growth rate's a little bit stronger here. We're at 21%. So that is a very healthy growth rate, but this again is also declining. You have a steady decline of the growth rate, but of course 21 is still very solid. So let's look at the forward price to earnings ratio and see how we're doing there. So the forward PE is, again, it's declining, but you can see here that it was, again, a high flyer during the COVID era when the money printer was going burr. It was trading at 104 times earnings, not even current earnings, but forward earnings, right? So 109 times forward earnings. So these stocks were just so expensive, so euphorically overvalued that it was inevitable that eventually these stocks would flatten out and enter a period of consolidation or even an aggressive decline. And we're kind of seeing both of those right now, right? Because these stock prices, these stock charts have really leveled off the last 5 years, right? As we just mentioned when we were looking at the charts, a lot of these names haven't done anything for 5 years. They've been treading water, they've been chopping. And now the valuation is starting to come down aggressively here. But eventually, the valuation will get to the point where it is now reasonable once again. And once that floor is sort of placed on these stock prices or these valuations, then you can begin to see the next leg up. But you really have to have that normalization of the valuation first. And that is exactly what's happening right now. We're seeing this period of consolidation. We're seeing a period where the multiples are beginning to normalize, and eventually a floor will be established, and that will lay the foundation for the next run up. With all of that being said, what am I personally doing? Well, to answer that question, I am currently doing absolutely nothing. I am just watching this all play out. I do not think now is the time to, FOMO into any of these names. I think now is the time to just add these companies to your watch list and follow the story. Get to know the business, get to know the market, get to know their fundamentals, their future growth levers, and just take a step back and learn about these businesses, because I do think there is tremendous value in this sector. And I think that there are eventually going to be names that emerge out of this sector that will greatly outperform the market over the next decade. But you have to be savvy, you have to be patient, and you have to wait for the right opportunity. So what I'm doing is I'm just creating a watch list of these companies and getting to know them. And I might buy shares of some of these stocks. It could be a month from now, it could be 6 months from now, who knows, it might be a year from now. But it's all about taking in information, right? You want to have an abundance of knowledge and information before making an investment. But the reason why I'm watching the sector is because I love to see when sectors get sold off aggressively, because that creates opportunity. But you have to be smart about it, and you have to know what you're doing, and you have to really have a deep understanding of these businesses and what they can potentially do going forward. All right, guys, thank you so much for watching my video. Stay tuned for the next one.